This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Well, Ken, good to see you.
Well, it's nice to be back from the desert, but can't believe it's April already.
I know, tax season.
The dreaded tax season.
I know it's a pain for everybody. We're going to get through it. Always a challenging time collecting tax slips and all that, but we're almost there. We'll make our way through it, and hopefully a lot of the accounts don't drag their toes, knock on wood, to say the least. But so obviously end of the first quarter. Wow. A lot of things have transpired. So this quarterly update, as we always do, is to inform our clients, everybody involved at Verus, what's going on, what are our thoughts for what's transpired, but most importantly, what is that viewpoint from our standpoint moving forward? So Ken, I'll let you dive into your segment on what you'd like to go through and a little bit of the market update.
Yeah, thanks. It's, let me tell you, it's been an interesting time of late, thinking that in 2023, it was a rocky road. Mm-hmm. And then we saw the phenomenal returns in November and December of 2023, and the S&P finished up the year 24%. So it was pretty hard if you were on the wrong side of that, like the Michael Wilsons at JP Morgan.
Definitely.
And then to think that in the first quarter of this year, we had the best quarter since 2019 with the S&P 500 up 10%. Like 34% in a 15-month period.
Crazy.
It just doesn't get any better than that.
No doubt. And like you said, if you were on the flip side of that equation, that's a tough pill to swallow.
Yeah, if you got it wrong, wow. Yeah. And thank goodness at Verus we were on the right side of the equation.
Definitely.
I wouldn't want to have to be
explaining that one.
We have to explain why we're in Canada still all the time.
Yeah, we'll get to that. We'll get to that.
But at least we don't have to explain why we were 58% in cash. So, lucky on that one. But this is a good sign. And you can't, obviously, as I say on these podcasts, you can't manage money by looking in the rearview mirror. Mm-hmm. However, when you do look in the past, it does give you some idea. So anytime the S&P 500 has had a first quarter return of 10% or more, the following 9 months has had an average annual rate of return of 6.5%. 91% of the time.
Wow.
Well, the odds are in favor. Mm-hmm. I mean, the second quarter here hasn't got started
rocky
start to the second quarter. But in the second quarter, after a 10% first quarter in the S&P, the second quarter has delivered on average a 2.7% rate of return in the second quarter. So, we're going to talk about in a few minutes here about things that are priced to, that some areas of the market are definitely priced to perfection. Mm-hmm. Well, here's the performance of the markets basically around the world. What you're seeing from this chart, I think, is you're seeing a broadening, not only of the rally in the U.S., but it's finally started to extend into Canada in some shape or form. EFA is still doing well, which is Europe. Australia, Asia, and the Far East. I mean, very respectable rates of return. The only one that really, from the equity standpoint, is the Russell 2000. Didn't join the party as much last year, and it's kind of lagging again this year. Certainly get into that. And because, it appears the economy is barreling around, creating new jobs in the U.S., and inflation looks like it could be stickier, and rates could stay higher for longer, and that's why...
Yeah, it's articulated its way into the fixed income market, right?
Yeah, and
so slightly down.
Slightly down, but again... I think the Russell and the bonds, it's kind of like what Wayne Gretzky said. It's not where I go to where the puck is going to be, not to where it's been. Mm-hmm. And so I think when you look and you take that quote from Wayne Gretzky, it gives me a sense that I see value and we see value in the Russell and also in the bonds with the inevitable drop of interest rates, and I know you're going to allude to that, Cody, that it's definitely going to come. What's interesting is, again, in the S&P 500, you can see that technology had a very strong return, and the contribution that you see on the far right-hand side, again, technology accounted for 3.85% of the total return. What's very different, and you got to understand in Canada versus the U.S., when we look at communication stocks in Canada, we're talking about Rogers, we're talking about TELUS, we're talking about BCE. But when we're looking at communication services in the U.S., yes, we're talking about Verizon, mm-hmm. but we're also talking about Meta. Yep. We're also talking about Google. So it's very different how they classify those companies. And so you can't really draw a parallel very well to the subsectors in the U.S. versus Canada. But again, the illustration of this slide is quite clear, is that one more time, you're seeing technology account for the lion's share of the gains. Mm-hmm. And,
And it's interesting to note, even on that technology front, NVIDIA contributed just over 2% of the 10% rate of return on the S&P 500 for the first quarter. So you didn't own NVIDIA for that, you lost out on 2%. So that's a massive contribution to the index.
I'm going to certainly talk about NVIDIA in just a moment here. But certainly here, the Russell has lagged mm-hmm. last year. There is a correlation between the S&P 500 and the Russell. And I think that the gap that we're seeing between the S&P 500 and the Russell now creates some opportunity for our very small to mid cap mandate. So excited about what the prospects of that are as we work our way through the year. This is interesting because here's the subsectors of the TSX. And I think it's really funny. Yes, healthcare had the greatest rate of return, at 24.2, but we don't have any healthcare companies in Canada.
Well, we did. They were the pot stocks that blew up.
Exactly.
They were there at one point.
We don't have a Pfizer. We don't have a Johnson and Johnson. Is the Eli
all
Lilly.
The ones that were there. Remember Valiant Pharmaceuticals?
It used to be the largest company in Canada until it went bust too. But now the healthcare, it's mostly companies like Chartwell, which is the largest in that sector, which is basically senior assisted residents. Mm-hmm. So that's interesting, but. Also, the financials haven't really joined the party. Year to date, Royal Bank's up 2%. Year over year, it's up 4%. TD is down 5% this year. Year over year, it's up 1%. And the poor communication sector. I mean, both Rogers and TELUS are both down 9% year to date after 3 months. And year over year, TELUS is down 21%, mm-hmm. and Rogers is down 16%. So when you look at this and say, okay, the second largest sector is energy.
Yeah.
Right? And, as we've always alluded to, Energy is really not a long-term hold to make a lot of money in oil and gas stocks. You've got
the capital gains aren't there. You're just looking for dividend income, right?
Absolutely. But what I find fascinating is when you take a look at the money flows, and this chart can be replicated to Canada as well, but you continue to see the huge money flows going into technology. Mm-hmm. Energy had a great quarter, and what do we see?
Still outflows from that sector. Yeah, I know.
It's a classic case of investors always getting it wrong.
Yeah.
Right. Like
they're chasing what's hot at the moment.
Yeah. It's
and
like,
tech's hot as ever.
Tech is absolute as hot as it possibly could be. Mm-hmm. And when you take a look at the tech companies here, and here's where you can see how the Meta and the Google get classified into that communication services. Mm-hmm. But there's 195 countries in the world today. And if you look at Apple and Microsoft, their worth of those companies, their market capitalization is greater than almost every country in the world. 195 of them. There's only 6 countries in the world that have a larger GDP than Microsoft and Apple. So when you look at the magnitude of that and the money going in, think of the fact that Apple and Microsoft are larger than the economies of Italy, France, Russia, and Canada.
It's crazy.
Crazy.
Almost tough to wrap your head around.
Yeah, and I think you need to put it in perspective. Same with NVIDIA.
Yeah. Okay,
so in one single day, the stock, February 22nd,
I remember
the stock goes up. And you and I had the discussion that morning, and we were just kind of going, fingers crossed, because if they didn't come out with earnings that
they're dragging everyone else with them,
they are what's keeping the boat afloat. Mm-hmm. And so when you take a look at the fact that on February 22nd of this year, they announced quarterly profits of $24 billion. Now, I know you at home viewing this say, well, $24 billion, it's just a number. I get it. Larger the numbers get, I think sometimes it's harder to put it into context. But let me attempt to put it into context for you. $24 billion in one quarter. That $24 billion is larger than the market capitalization of TELUS. It's larger than Rogers, and it's larger than National Bank Financial. Like, if that doesn't put it into perspective for you, and it also have to say, hey, on this guy, okay, the million, this guy's photo is, hey, this is February 22nd. Let's roll with this thing.
How many out of money options did he have?
Hey, we're not smart enough. Even after 40 years, I'm not smart enough to tell you where this thing's going. And I do realize that the saying, the trend's your friend, is powerful. Mm-hmm. And there's no question that this market could go higher.
Yeah, and we talked about this on a previous podcast where a lot of the market today, in terms of what we're seeing, is there's a heavy preference to momentum-based strategies, right? And it's a momentum chasing, I don't want to say game, but it kind of is at this juncture.
Yeah. And, so in some aspects, certainly on the technology side, the market is priced, in our opinion, pretty much to perfection. Mm-hmm. And the whole context of the move here is, will the rest of the subsectors start to join the party? Because I think a crucial day is going to be May 22nd when NVIDIA announces their second quarter profits. Mm-hmm. Mm-hmm. And I don't know how you exceed 24 billion, but when you take a look at the Shiller PE ratio, which is basically 10 years rolling earnings adjusted for inflation, and we're at 34. The mean, the average is 17.11. I mean, clearly here you can see the top part here being the tech bubble. Then you can see here being the financial crisis at the low.
Yep.
And where we took the opportunity is when we started to put more risk on the table was right down here. And those are the October lows of 2022. So we're cautious. As we said at the beginning, we're cautiously optimistic. However, we have concerns about how the strength in the technology sector continues. And we are certainly, and we can reassure you that we are, as usual, being proactive rather than reactive. And we are managing your portfolios accordingly. So that kind of gives you a summary and a flavor. We'll see what transpires over the next 3 months, and then we'll be back at you at the beginning of July, and we'll have more for you. And I think it's a good time to pass it over to you. And
Yeah, great. Awesome.
Okay. All right.
Perfect. Yeah, so speaking just about Ken's saying that we're proactive rather than reactive, if we recall from our last quarterly podcast, right at the beginning of the year, we were talking about, at that point in time, the rebalancing and the strategic changes that we were going to be making in the portfolio, right? Mm-hmm. So after U.S. focused growth being up 40% for the year, international being up, it was a no-brainer for us to say, you know what, hey, have a level head, take some profits. And at that point in time, and still I think at this juncture today, the alternatives out there with the market, from our perspective, being priced to perfection, are kind of tough. There's not really many opportunities out there at this juncture. So in our mindset, there are some risks on the table that we are going to talk about, but we were proactive in raising some cash that is earning 4.85% at this juncture to sit there as a portion for us to deploy if an opportunity presents itself.
Yeah. When the market goes straight up, it's hard to add value, but when it starts to go the other way, that's where we can add value. And I always want you to remember the good old saying is, you never have a profit
until you take it.
Until you take it.
Exactly. So just quick mandate review, and wanted to just keep it quite short, concise. We are going to be giving you the quarterly performance and holding details. So you will see not only the quarter performance, but also with the new holdings report, seeing your exposure to each one of the 6 mandates listed there. Mm-hmm. Okay. So overall, relatively good start. Very decent start. Every single one of the 6 mandates, including the fixed income, which the benchmark was negative 1.22, is positive.
Well done, Cody.
There we go.
Yeah.
Fantastic. So U.S. focused growth leading the way again, just because of the hot start in basically January is where a lot of that attribution came from. But we still saw some broadening in the Canadian equity space, right? So up 5.73%. Our U.S. small cap, although the Russell was a little bit sluggish, ahead of its benchmark at 6.99. And then strategic alternatives. As much as some people may be saying it's going nowhere, it seems to just kind of hold in there. That's what it's designed to do. And especially, I think, as I'm going to go through these next slides, is it's important to understand when markets are going up, you always want, we 10 clients always
own everything that's going up.
They want to own everything that's going up. Why are we not buying more U.S. focused growth at this juncture? Right? Why are we not buying more international?
45%?
Well, because the fact of the matter is, if we tend to forget what happened in 2022, the obliteration when policy rates went to multi-decade highs, you saw the crippling effect that it had on long duration growth stocks. Yeah. U.S. focused growth was down, but what held up?
The Canadian marketplace.
The Canadian marketplace and alternatives. Alternatives was our only positive mandate for the year. And so each element of our portfolio is designed to perform in different market environments at different points in time, right?
Exactly.
We don't want everything going up simultaneously at once, because if it happens the opposite way around and everything drops simultaneously, we're in a whole lot of trouble.
And that's why I think, as clients, and I will say this, you have selective memories. And when you have selective memories, it's like you forget about 2022, that that your Canadian component was the one that saved our bacon, and having the alternatives that was positive saved your bacon. So again, try not to have select memories and take this as a medium-term view.
Yeah, it's got to be the full picture, right?
Yeah.
So all of the performance results will be delivered in the next week or so. We're going to be getting that out to each and every single one of you. And yeah, not really many other drastic changes at this juncture, because what I'm going to go through next is there's a little bit of a holding pattern right now, and there's some risks on the table that I want to go through. So I'm going to highlight what is the noise that's out there in the market, right? And a lot of the noise from a market standpoint is this: another record after another record
after another record
after another record. So you look at the MSCI All World Cap Index, basically the full picture of all stocks in the entire world, reaching record highs, right? And we keep seeing it on the Dow. We keep seeing it on the S&P 500, and that's the story. And so people always tend to forget, though, the stock market and the economy are two totally different things, right?
Exactly.
And people tend to say, oh, well, hey, stock market's up. That must mean good news for everything. Mm-hmm. But what's interesting is as we keep hitting record highs, we kind of have a different story that's unfolding in terms of the actual economics behind the scenes. And that is, we're seeing a world from an economy perspective that's actually less resilient than most people have anticipated as we've kind of reached these record highs. So out of all the G7 countries in the world, if we take the annualized change from essentially the second quarter of 2023 to the fourth quarter of 2023, we have 3 countries in the G7 basically in contraction territory. We have 3 which are plateauing or stagnant, and the only one that is essentially holding in there and carrying the weight
is the U.S.
is the United States of America.
And you have to understand that the U.S. at COVID, they had the largest amount of stimulus. That stimulus was $4 trillion. So substantially more than any country.
Yeah.
And that's what has propelled.
And the thing is, as I'm going to touch on a slide that I have, is that stimulus hasn't stopped, actually. Even though we're at peak policy rates, if we look at it from not a monetary perspective, but a fiscal perspective, they're still injecting money, still injecting spending, right?
Yeah.
And so we take a look at what's kind of happened here, and we're going to focus more on North America, what's close to home, but there's a massive divergence at this juncture between what's happening in the United States and what's happening in Canada. If we take a look at the United States, and we take a look at the real GDP per capita, okay, there has been a constant trajectory upwards for the United States since COVID. Mm-hmm. In Canada, yes, we were a little late to reopen. We stayed at home a little bit longer, but that doesn't really provide the full picture because even after everything has been fully opened, you take a look after 2022, the spread has completely widened. And so there's something challenging going on in Canada that I wanted to talk about. But first, I wanted to just pinpoint, why is the U.S. economy so resilient at this juncture, right? Third quarter of 2023, GDP comes in at 4.9%. Massive. Yeah. Fourth quarter of 2023 comes in again, big number, 3.3%.
Yeah.
Right? $27 trillion of U.S. GDP generated in the fourth
Pretty
quarter.
hard to have a hard landing on with those numbers.
Exactly. And when you have a resilient consumer that accounts for 67% of your overall GDP or 18 trillion of the overall Q4 print, that's big.
Yeah.
That's big. And a lot of the market pundits that expected higher interest rates to have a very big impact on the US consumer in 2023 got it dead wrong. But will that, and this is the question we've been asking, is that going to continue, right? It's a little bit, it's up in the air. There's going to be some challenges for sure. But the consumer has remained resilient, which has helped the US economy.
Yeah.
But I think another thing on top of that, which is also really big, is we take a look at the US fiscal spending, right? And so from that perspective, the US fiscal spending is at this point in time.
That was opportunity knocking, by the way.
Yeah. Sorry, that was
sorry
quite,
about that.
That was insane. Sorry, I completely lost my train of thought. It's like a hammer going on out there. That was crazy.
You know what I say?
Sorry.
See, I didn't even have to pound the table. It's opportunity knocking.
Okay. Usually I don't get distracted by that and I can go through, but that was insane. Okay. So one of the big things besides the resilience of the consumer that most people aren't aware of, that's also really propping up the U.S. economy at this juncture, is the amount of fiscal spending that's going on, right? And it's unprecedented. You highlighted COVID just earlier about the amount of, obviously, monetary policy that was there, but we continue to see record deficits that are, I would say, just kind of propping up the economy with debt, right? And this is, I think, something that is completely unsustainable. You take a look.
How long can you borrow this level of money before you pay the price?
Look at the net interest payments that you're making on this debt.
Yeah.
So you don't, like, at this point, the U.S. is making, I forget the exact number, but the amount that the U.S. is paying in terms of interest on their debt is astronomical. And if people think that they can hold it there for eternity and not lower rates to lower that interest cost,
not a problem when rates are near zero, but where rates are today, you can see the huge, increase in the red line. That's a challenge.
So U.S. economy holding up the lot, but I think Powell has done a good job in terms of obviously achieving a soft landing here, but there are obviously some concerns, but he's, I'd say, a little bit more open to the premise of rate cuts in the United States versus our fiscal leaders here are completely delusional.
Yeah, I was wondering, do we have fiscal leaders in Canada? I was just wondering.
Yeah, it's tough. So we take a look at the Canadian economy, right, compared to the United States. Third quarter 2023.
I know the numbers.
Down 1%, right? Then fourth quarter, barely escaping what is considered a traditional recession. We posted just a small positive number. So Canadian economy, describe it in one word, hanging on for dear life.
Yep.
And so what is going on in Canada here, right? Our GDP is flattening. Our standard of living compared to the United States is at a massive divergence. What the hell is going on? Well, there's a couple things. Yep. The first is, and we've done some writing on this extensively in our wealth notes. If clients have been reading them, we talked about.
You gotta read those wealth notes.
You gotta read the wealth notes. They're good. We talked about Canada's population trap. So at this point in time, Canada's population has gone absolutely exponential. Record levels off the chart. I don't even need to dive into the numbers, but because you can just see how crazy this has become. And so a population trap is essentially defined as, and a population trap actually happens in more developing countries. Yes. And it's essentially when you are having such a large population growth that the existing capital labor ratio is not keeping up. So what that essentially means is all of the investment of your country is being utilized to get those new citizens and those new people that are part of your country now up to speed instead of progressing everybody else that's already been in the country.
Everyone else is left in the lurch.
Right? So the population trap is something that's huge because you take a look. If we're immigrating new people into our country and we're bringing millions, 1.3, I think is the number.
Yeah.
Absolutely astronomical. Because if you're coming to this country, what is the first thing you need to find?
A job.
You need to find a job.
Then you need to find somewhere to live.
Exactly. Tight job market. Tough to find a job at this juncture. Low unemployment rate. And especially with the private sector, if you take a look at the employment, if you dissect the unemployment numbers, we've actually only seen growth in the public sector of employment. Yeah. Private sector employment has actually been stagnating for quite some time. Mm-hmm. But if you're also coming to this country, you need to find a place to live.
Good luck.
And tough to find a place to live when you have one of the largest housing supply deficits ever on record.
Yeah.
At this point in time, we are essentially 5 standard deviations away from essentially the ratio of growth in the working age population to the number of housing starts. For every 5 people coming to this country, there's 1 housing start. Mm-hmm. That is a massive, massive deficit. And so we are already at construction capacity in terms of housing starts. And in order to correct this deficit of 5 standard deviations, you would need to double an already maximized housing construction segment.
Not going to happen anytime soon.
Not going to happen anytime soon. So the moral of the story is that is going to articulate its way into inflation. You have limited supply of homes. You have now a relentless amount of demand through immigration. And so what you see is the shelter component of the consumer price index is essentially doing all of the lifting of inflation.
Yeah, it's doing all the damage.
All of the damage. So mortgage interest costs are huge. That was the biggest component of the most recent inflation print, up 26% year over year. The second biggest component was rents. If we strip out the shelter component from the CPI print, which the Bank of Canada is so stubborn by just utilizing a metric that's very old by taking into account these sectors, we're at 1.3% inflation. Mm-hmm. And we're still at peak policy rates.
Makes 0 sense.
And on top of that, you see, as we've seen, we have stagnating growth. And that just goes to show, too, we take a look at our labor productivity in Canada. 3 consecutive years of declines in our productivity.
Yeah. I think Tiff's got this thing completely wrong.
It's tough out there in Canada. And I know Canadians are feeling it.
Just take a look at Trudeau in the last couple of days. I haven't read completely up on it, but offering the huge incentives to all the provinces for housing, but to develop new houses, but he apparently has put on all these stipulations, and I think Ontario and Quebec have already turned it down, saying.
But the thing, it all comes down to this. We have a government that's not supportive of business activity. Just like his father, Justin Trudeau, is not supporting businesses, right? Yeah. And so what we're seeing is everybody is essentially fleeing Canada. Investment is fleeing Canada at an alarming rate, and that's leading to a major divergence in terms of our GDP with the United States, as we've seen, but also in terms of our markets as well. Yeah. This graph goes to show you essentially the net international transactions in securities, both the amount of domestic trades, but also foreign trades of Canadian stocks, basically. And you can see at this juncture that we're back to almost 2007 levels as everybody is fleeing the Canadian market.
And that puts an enormous amount of pressure on the Canadian dollar.
Puts an enormous amount of pressure on the Canadian dollar. And also goes to show you why Canadian stocks have also gone nowhere, because you have fund flows essentially working the opposite way.
Yeah.
And so the result of that is one of the greatest divergences between the Toronto Stock Exchange and the S&P 500 in terms of their forward priced earnings, basically ever on record.
Yeah.
Okay.
It's pretty correlated until you get to the far or right-hand side of that chart.
Exactly. So very, very tough predicament in Canada, to say the least. And it'll be interesting to obviously see what unfolds, because I think, as we've alluded to in previous podcasts, I think if the Bank of Canada just remains restrictive, they are setting themselves up for a severe policy mistake. And by the time that they find out that they've made a mistake,
too late.
The damage has been done, and they will have to cut rates faster and deeper than they ever anticipated.
Yeah, and then why don't you make a brief comment about why we're in Canada in terms of the dividends, and, and if TIF is dead wrong like we think he is, and rates are going to have to come down, that's great for our fixed income product, and it's going to make those dividends that we have in our high income mandate substantially more attractive. But maybe just allude to that.
So I'll allude to that. So the whole thing, after kind of explaining, and I know that was a lot, but that's the noise that's going on out there.
Yeah.
There's a lot of it. Record highs, what's going on in the US economy, job numbers coming out, inflation, Canada seems amuck. Like we've gone through, there are a lot of things out there. There's a lot of risks and a lot of noise. But I want to take the time to step back and say, okay, let's go beyond this noise. It's the name of our podcast. And let's just hone in on essentially what we can focus on, right? And so that was, as we've already alluded to, the key thing was, one, trimming our risk, trimming our profits that were taken, obviously, in 2023. Utilizing Canadian equity, even though we have our concerns about Canada, is still a key importance in terms of our overall investment strategy for one key reason. And it can be summed up, like I've said in our wealth notes, in one word, and it's dividends. When we enter a stagnant growth environment, usually growth stocks do not go well. And what you're looking for in an environment of stagnant growth is income. You need income to get you through lulls. And there's no better place for Canadian investors, especially with the tax credit received, than receiving Canadian dividends. You take a look at actually the 10-year rate of return of the Toronto Stock Exchange. Out of the essentially 9% rate of return, 44% of that return is actually dividends as a whole.
Big number.
It's huge. And so if we are entering the stagnant growth environment,
we'll get there.
I'm sure we will get there. We're not so much worried about the capital suppression that will happen, because I think there's already a substantial discount on the S&P 500. The market is forward looking. It's probably already taken into account a lot of that.
Yeah.
So Verus High Income yields at this juncture exactly 5.01% in terms of dividend yield. By sitting patient and waiting just for a year, zero appreciation whatsoever on any of the stocks, just collecting income 5%.
I'm just looking at you clients now that are asking that question. Why are we in Canada? You're getting paid to wait.
Exactly.
Handsomely.
And from an after-tax perspective, it's extremely tax efficient to have Canadian income, Canadian source dividends flow to you instead of interest income.
Yeah.
Right? So, and on a kind of sub note, okay, well, why wouldn't you, if you have that pessimistic view of the Canadian place, why wouldn't you allocate somewhere else for that matter? Well, Ken was talking about the U.S. seems pretty priced to perfection at this moment. God forbid if we actually do enter any type of real economic pain, the first thing that's going to go is probably the growth, right?
Yeah.
So
mark your calendars, May 22nd.
Lots of noise, but the premise is we're being patient. We've taken our profits where profits were needed. We're searching for income in what we believe is going to be a very stagnant period of time for growth, but we're going to remain opportunistic in essentially our deployment of that cash, because we do think over the coming months, and who knows, nobody has a crystal ball, right? We're not fortune tellers, but we believe at some point in time, opportunity is going to present itself, and we don't mind being paid, you being paid to wait.
Yeah.
So that pretty much wraps up my portion of the presentation and the quarterly update. The last thing that I did want to go through is the administrative items that will be coming to you. So the first item being the performance and holdings report for the first quarter will be sent. The new format that we've switched over to, which includes the holdings detail along with the discretionary performance, all of it will be delivered most likely over the next week or two here. Okay. And the second thing is our March 2024 wealth notes will also come out as well. We've been distributing these monthly now. And if you haven't read them, some issues are a little bit complex, but we try and break it down into different segments for people. If you want to know a little bit about the economics, we essentially have 3 points in the economic section that talk about 3 key things that we're looking at. We break down the market in terms of geographic realms. Here's US equity, here's Canadian, here's fixed income, here's alternatives. Have a read over it. It's very valuable information that we produce for all of you and all of our clients every single month.
And I think if you're a little more proactive in reading it, we love talking to you, so don't get me wrong, but I would say 80% of the questions that you're answering, or you want us to answer for you, we've already answered those questions in the wealth notes. And so we always refer you back to the wealth notes.
Exactly. Well,
here we are.
We did it. And then obviously we will be giving the podcast at the end of June for the second quarter. We'll still be delivering the wealth notes, but our semi-annual reviews will start in July.
Yeah, so I will be as you know, I talk to all of you in mid to late January, early February. I got a hold of all of you, and then I start that cycle again right in around July 10th to 15th once you get your second quarter QPRs. So I will be calling.
Great. Awesome. Okay. Well,
all right.
Appreciate it, Ken.
Thank you very much
thank you, everybody, for taking the
watching.
time.
Appreciate your business and the trust that you put in us. It's greatly appreciated.